Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to business combination Indian Accounting Standard 103 Part 5. In previous 4 discussion, we had discussed various concept of business combination. We had discussed about the what is business combination is what one entity acquire control over the another entity. Then we had discussed about the definition of control means as per Ind AS 110. Control means when one entity have voting rights over the another entity. One entity is having a potential voting rights over the another entity. The one entity is having power to appoint, power to remove the KMPs of the another entity. When one entity is having to decide the remuneration of the KMPs of the another entity. When one entity has rights to receive the income, dividend or interest income of the another entity. When they have the power to change the profits of the another entity. And in that case, that entity is having a control over the another entity. Combination is to be done in various forms. Like we had discussed that business combination is done in the form of merger, in the form of amalgamation, in the form of acquisition of businesses. When one entity acquire another entity, another separate legal entity. And also we had discussed about the asset acquisition where the entity focus on the acquisition of the assets of the another entity. The business combination is done only to acquire the asset of that organization. And then we had discussed about the definition of business. What is business? Business is a set of integrated activities. There is an input is inserted in the business and we had to process the input and the output is to be generated. Why the entity is doing business? In order to generate the income, in order to generate the profits, in order to generate the interest income, in order to generate the income from investments. If the entity satisfy the condition of the business, then it comes under the purview of Ind AS 103. If it does not satisfy the condition of business, then it is out of the scope of Ind AS 103 and then it follows the general accepted accounting principles if there is no separate standard available. Then we have discussed what are the elements of business, like there's a input, there's a process, the entity insert an input, that input is to be processed and output is to be generated in the form of income. Substantive process means the input is there, the process is there, but output is not there. But the skill workforce is there to generate by inserting the input and process. They have the capability to generate the output. They have the capability to generate the income. That is the substantive process. Then we had discussed the difference between the AS 14 and AS 103. AS 14 is limited in scope. They only discuss about the merger and amalgamation, but in AS 103 it is very wider in scope. It discussed about the amalgamation, it discussed about the asset acquisition, it discussed about the acquisition of businesses, acquisition of business as of separate legal entities. So AS 14 is limited in scope, but business combination is wider than AS 14. Then we had discussed about the difference between business combination, asset acquisition. If the purpose of the business combination is to acquire the business of the organization, whole business of the another entity, that is all the assets and liabilities, all is to be acquired. And in AS 103, accounting is to be followed in case of business combination. The purpose of the asset acquisition is to acquire the asset of the another entity, only to acquire the asset of another entity, not the liability, not the process. Goodwill is to be recognized in business combination. In asset acquisition, no goodwill is to be recognized. In business combination accounting, deferred tax is to be calculated and accounted for, but in asset acquisition, no deferred tax is to be calculated and counted for. Transaction cost in business combination, in case of consolidated financial statement, it should be charged to profit and loss account, but in standalone it should be capitalized with the value of asset. But in case of asset acquisition, it should be capitalized with the value of the asset. So these are the differences which we had discussed. Then we had discussed about the concentration test. In order to check whether the transaction is an asset acquisition transaction or a business combination. If the fair value of the gross asset acquired is substantially equals to the fair value of identifiable asset or a group of assets, it is a case of asset acquisition and not a business combination. Methods of business combination, the acquisition accounting and the common control transaction. What is an acquisition accounting? Acquisition accounting is an accounting where an entity acquire another entity outside the group, and common control the method where an entity acquire within a group. Entity acquire another entity within a group, then it's a common control. And if an entity acquire outside the group, then it's an acquisition account. Acquisition accounting is to be done at fair value. Common control is to be done at book value. Then we had discussed about the steps in acquisition method. What are the steps we had discussed? We had discussed about the who is the acquirer. The person who acquired the business is the acquirer. The person who acquired the control over the another business is the acquirer. Then we had discussed the date of acquisition, how to determine the effective date is the date of acquisition. When date of acquisition is that when you have the control over the entity, when you pay the purchase consideration, and if you get the CCI approval, the regulatory approval which is necessary to determine the date of acquisition, that is important, but shareholders approval is not important to determine the date of. Then we had discussed about the determination of purchase consideration. Purchase consideration is to be determined in the form of cash, in the form of asset, in the form of liability transferred, in the form of equity shares transferred, in the form of contingent consideration transferred, in the form of deferred consideration transfer. The consideration that will depend on the occurrence and non-occurrence. It will be decided in the future day that I will pay you some amount if that approval you get in future after 2 years, or if that purchase order you get after 2 years, I will pay you extra. That is the contingent consideration. And deferred consideration is that the amount you decide today, but it is to be paid in future. The amount is decided that 100 crores is to be paid. Out of that, I will pay you 50 crores after 2 years. So that is the deferred consideration, and it should be recognized at present value today. So that is the deferred consideration. Then we had discussed about the transaction cost. Transaction cost in CFS, it should be charged to profit and loss account, and in case standalone financial statement, it should be capitalized with the value of the asset. Now step 4 related to acquisition method of accounting, that is the recognition of asset acquired and liability assumed. Then in case of business combination, all the assets acquired and liability assumed is to be recognized at fair value. Now there are some exceptions are there. Exceptions are what? Which are not present in the financial statement, in the balance sheet of the acquirer, but it is to be recognized in the books of the acquirer, which is at fair value. That is the recognition exceptions. What is the item which is not present in the balance sheet of the acquirer, but still the acquirer will recognize that item in its books at fair value. Contingent liability is not recognized in the books. Generally, it is not recognized in the balance sheet. It is disclosed in the notes to accounts. The another exception is recognition and measurement exceptions. There are 4 exceptions are there, which is recognition and measurement. Recognition and measurement exception means which is not in the balance sheet of the acquirer. Entry is not present in the balance sheet of the acquirer, but it is recognized by the acquirer in its books, but not at a fair value. They will not recognize that entry at fair value. They will recognize that entry, but not at fair value. What are the entries? That is like income tax. They will recognize as per Ind AS 12. Lease assets, they will follow Ind AS 116 for that. Employees benefit, they will follow Ind AS 19 for that. And there is some exceptions are there, that is measurement exception. Measurement exceptions means it is present in the balance sheet of the acquiring company, and it is also recognized in the books of the acquirer, but not at a fair value. They will follow the recognized standards for that, because share based payment they will recognize, they will follow their relevant standard for that. Reacquired rights they will follow. For that they will recognize there some principles which we will going to discuss, and the non-current asset held for sale they will follow Ind AS 105 for that. These assets are these
share-based payment, reacquired rights, and non-current asset held for sale are present in the balance sheet of the acquiring company, they will recognize, the acquirer company will recognize this by following the relevant standard, not at fair value. So the step 5 of the acquisition method of accounting, that is how to recognize and measure intangible assets if it is present in the books of the acquiring company on the date of acquisition. On the date of acquisition, if any hidden intangible is identified, then it should be recognized at fair value. Example of hidden intangibles, like any patent is there, any trademark is there, customer list of B Limited, brand is there, license is there, license to operate power plant. Non-controlling interest. Non-controlling interest means acquirer company is having a choice to recognize non-controlling asset. On the date of acquisition, they will acquire at fair value, or they will recognize that non-controlling interest at fair value or proportionate value. Proportionate value means in these cases non-controlling interest is computed on the basis of percentage, like non-controlling interest value, fair value of net asset into percentage of non-controlling interest into period.
So the step 6 is related to the recognized goodwill. How to recognize goodwill or bargain purchase. So how to compute goodwill? Purchase consideration less net asset acquired at fair value, add non-controlling interest at fair value, add fair value previously held stake, add contingent liability at fair value, less indemnification asset, less intangible asset, then comes out the goodwill. On goodwill, deferred tax is to be computed at enacted rate in force. Today we are going to discuss about the bargain purchase gain, because in the previous class we had discussed about the computation of goodwill, but we had not discussed about the bargain purchase gain. Now today we are going to start with bargain purchase gain, how to compute or recognize bargain purchase gain. So let's start. How to recognize bargain purchase gain? If it is clearly evident that acquisition happened due to bankruptcy, distress sale, or due to the sale of business as per the regulatory requirement, then recognize that bargain purchase gain in OCI and accumulate in the equity as capital reserve. But if it is not clearly evident that for what purpose the acquisition has happened, then accumulate in the equity as capital. This is to be explained with the help of examples. Suppose on 1st January 2024, A Limited acquired 80% equity interest of B Limited in exchange of rupees 50 crores. Former owner of B Limited were required to dispose of their investments in B Limited by specified dates, and accordingly they did not have a sufficient time to find the potential buyer. A qualified valuation professional hired by the management of A Limited measures the identifiable net asset acquired in accordance with the Ind AS 103 at rupees 65 crores. So the net asset fair value is equals to 65 crores. The fair value of 20% non-controlling interest is rupees 13.5 crore. Now how should A Limited recognize the bargain purchase? In this case, we have to determine or compute the bargain purchase gain. In this case, A Limited acquire 80% stake in B Limited by paying a purchase consideration, that is 50 crores. Now, as per the valuation made by the management of the A Limited, they determine the fair value of net asset acquired, that is 65 crores, and the fair value of non-controlling interest is also given, that is 13.5 crore. Firstly, we will compute the non-controlling interest in this case, because the percentage of non-controlling interest is 20%, which is acquired by other company, because A Limited acquired only 80% stake. So computation of non-controlling interest by fair value of approach, that is it is given in the question 13.5 crores. On proportionate basis approach, we will take the fair value of the net asset, that is 65 crores, into the percentage, that is 20%, 13 crore. Now we will compute the goodwill or bargain purchase gain in scenario 1 and scenario 2, where non-controlling asset is recognized by following the fair value approach. That is, in scenario 1, purchase consideration is 80%, that is 50 crores. Net asset acquired at fair value 100%, that is 65 crores. Add non-controlling interest at fair value, that is 13.5 crores. So purchase consideration plus non-controlling interest, it becomes 63.5 crores, and less net asset, that is 65 crores. So it will be negative 1.5 crores. So it becomes a bargain purchase gain, because asset acquired is more than the purchase consideration plus non-controlling interest. So there is a gain on acquisition, that is bargain purchase. In scenario 2, the proportionate basis approach is to be followed. That is, purchase consideration is 50 crore, net asset acquired at fair value 100%, that is 65 crores. Add non-controlling interest 20%, that is 13 crore, which we had calculated. It becomes 2 crore. So that is also a bargain purchase gain. Now journal entry in scenario 1. At the particular net asset acquired, how much net asset acquired, that is 65 crores, to purchase consideration, for which the entity paid 50 crores, non-controlling interest is 13.5 crore, and the differential amount is bargain purchase gain, that is 1.5 crore. In a scenario 2, net asset is 65 crores, to purchase consideration 50 crores, to non-controlling interest 13 crore, to bargain purchase gain 2 crore. All the bargain purchase gain, it should be recognized in OCI and accumulated to equity as capital. Now another concept is measurement period. How to determine the measurement period? If the business combination accounting is not completed due to lack of the availability of information, if the company is not able to provide or collect the information, and business combination accounting is not complete, then company can update the business combination accounting in the next 12 months. That is, 1 year window has been provided, has been given to update business combination accounting. So the objective of measurement period is to provide reasonable time to complete the business combination accounting by obtaining information from the acquirer. So acquirer has given a sufficient time to complete the business combination accounting by obtaining information. So this window, 12-month period, 1 year window, has been given to update business combination accounting to the acquirer to get the information from the acquirer. Suppose A Limited acquired B Limited on 15th March 2024 and financial year end on 31st March 2024. That is the account closure date, and audit signing of date is decided by the management is 15th of May 2024. So the time is very late or to collect the information for business combination purpose, because the date of acquisition of business combination is 15 March, and after 15 days it becomes the financial year end, which is less than 12 months to update business combination. So in order to update business combination, 12-month period is it. In business combination accounting, goodwill and bargain purchase is also need to be recognized. Once all the information related to business combination is available, acquirer is required to adjust the updated information in the value of goods, provided such information or facts must exist on the acquisition date. Means only that information is adjusted with the value of goodwill, provided such information or fact must exist on the acquisition date. That information must exist on the acquisition date, but it will be collected or updated after the acquisition date. That information only adjusted with the value of goods. Any new facts or error identified subsequent to the acquisition date shall not be adjusted in the value of goodwill. Means any facts or any new facts or any event identified after the acquisition date is not recognized, adjusted with the value of goodwill. Above mentioned 4 points is explained with the help of example. Suppose X Limited acquire 100% stake on Y Limited on 1st April 2023 and paid a purchase consideration of rupees 150 crores. The fair value of net asset acquired is 100 crores. At the time of acquisition, Y Limited has carry forward losses and Y Limited has not yet recorded DTA in books of accounts due to lack of convincing evidences on the acquisition date. However, as on 31st March 2024, entity Y has won a significant profitable contract which is expected to generate the taxable income and hence DTA is recognized on these particular dates. Whether the aforesaid losses can be adjusted with the goodwill recorded based on the preliminary purchase price allocation. Means in this case, when the acquisition takes place, it will be taken place on 1st April 2023, where X Limited acquired Y Limited and paid a purchase consideration of 150 crore. And the fair value of net asset on that date is 100 crore. When the X Limited acquired Y Limited, there has a carry forward losses in the books of Y Limited and they had not recognized deferred tax asset on that losses because of the convincing evidences are not present on the acquisition date. But however, as on 31st March 2024, when they finalized, when X Limited going to finalize on the closer date, entity Y won a profitable contract and that contract is expected to generate a taxable income in future and hence DTA should be recognized on that. Whether the aforesaid losses can be adjusted with goodwill means these losses, aforesaid losses which are present at the time of acquisition but on which DTA is not recognized because the virtual certainty is not there whether these losses will be adjusted or not with solution. No, these losses cannot be adjusted with goodwill at the time of acquisition of Ylink. Because why these losses is not adjusted? Because goodwill is to be computed on the date of acquisition. On acquisition date, this profitable contract is not present in order to generate profits in future. Because of the lack of certainty, DTA is also not recognized at the time of acquisition. These profitable contract won by the Y Limited after acquisition date, that is on 31st March 2024 and not on the acquisition date. It is a post-business combination transaction and hence no losses will be adjusted on the acquisition date with goodwill. It is on 1st April 2023 by using measurement periodic exemptions. Now illustration 2. ABC Limited acquired XYZ Limited in business combination on 15 January 2023. Few days before the date of acquisition, one of the customers of XYZ Limited has claimed that certain amount was due by XYZ Limited under a penalty clause for completion delay included in a contract. ABC Limited evaluate the disputes based on the information available at the date of acquisition and concluded that XYZ Limited was responsible for at least some of the delays in completing the contract. And based on the evaluation, ABC Limited recognized 1 crore towards a liability which is a best estimate of the fair values of the liability. So in this case, ABC Limited acquired XYZ Limited on 15 January 2023. In the business combination, ABC Limited acquired XYZ Limited a few days before the date of acquisition. That is before 15 January 2023, one of the customer of XYZ Limited, one of the customer of the acquiry company claimed certain amount by XYZ Limited under a penalty clause. One of the customer of XYZ Limited has claimed a penalty for not completing a contract and there is a delay in completing the contract and for that one of the customer of XYZ Limited before the date of acquisition claimed a certain amount of penalty on XYZ Limited. So ABC Limited evaluate the dispute based on the information on the date of acquisition, then on acquisition date when the ABC Limited get to know the penalty which is on XYZ Limited. ABC Limited evaluate the dispute based on the information available on the acquisition date and concluded that XYZ Limited was responsible for at least some of the delays in completing the contract, and based on the information it recognized 1 crore liability at fair value on the date of acquisition. So 1 crore liability is to be recognized as default is found in the books of XYZ Limited on not completing the contract within on 1st October 2023 within the measurement period, that is 12 months is the measurement period from 15 January 2023, that is the date of acquisition, till 14 January 2024. 1 year window is given as a measurement. 1st October 2023 within the measurement period, the customer present additional information as per which ABC Limited concluded the fair value of liability on the date of acquisition is 2 crores. Now, during the measurement period, the ABC Limited get some more information about the liability which it recognized at the time of acquisition at fair value, that is 1 crore, but some additional information came out on 1st October 2023, that is within the measurement period he had determined the fair value of the liability 2 crore. Now ABC Limited continue to receive and evaluate the information related to claim after 1st October 2023. Its evaluation does not change since February 2024, when it concluded that the fair value of contingent liability of the claim at the date of acquisition is 1.9 crores. After February 2020, and ABC Limited determined that the amount would be recognized with respect to the claim under Ind AS 37 is 2.2 crores, which is after the measurement period. How should the adjustment to the provisional amount to be made in the financial statement during and after the measurement? What adjustment is to be made during the measurement period and after the measurement? So solution, evaluation of business combination. Firstly, we will evaluate all the transactions. ABC Limited has acquired XYZ Limited on 15 January 2020. Suit has been filed by the customer prior to acquisition date, and ABC Limited requires to pay certain penalty on that. On acquisition date, ABC Limited evaluated whether it is actually a delay or not, and they found that there is a delay and contingent liability should have been recognized at an amount of rupees 1 crore, and business combination accounting has done on 15 January 2023. Measurement period is 12 months after the acquisition date, that is from 15 January 2023 to 14 January 2024. Means that if any new information is available after the acquisition date for the event which is present at the time of acquisition, in that case it will be adjusted with the value of goodwill. On 1st October 2023, some additional information has came up, and on the basis of which the fair value of the contingent liability has moved to 2 crores. On February 2024, as by Ind AS 37, these contingent liability becomes 2.2 crores. After February 2024, that is after measurement period, customer has provided some additional information due to which the fair value of the contingent liability of the claim at the date of acquisition is 1.9. Step 1, firstly we will recognize the contingent liability. On the date of the business combination, you will recognize the contingent liability, that is on 15 January 2023, with the value of goodwill, that is considered as a part of business combination accounting. That contingent liability, that is 1 crore, become the part of business combination accounting on 15 January 2023 at the time of acquisition. Measurement period, that is second step to determine the measurement period. Measurement period is 12 months after the date of acquisition, that is 15 January 2023 to 14 January 2024. That is the measurement period. If any additional information available during the measurement period, it will be adjusted with the value of goodwill only if the events are present, the facts are present at the time of acquisition. but any additional information available after the measurement period, it should be charged to profit and loss. Step 3. So adjustment of additional information during the measurement period. If that facts are present at the time of acquisition on 1st October 2023, during the measurement period, the customer present additional information as per which ABC Limited concludes that the fair value of the liability on the date of acquisition is 2 crore. These additional 1 crore is recognized due to the facts exist on the acquisition date. Means if any new information is available after acquisition date for the event which is present at the time of acquisition, in that case it will be adjusted with the goodwill. So these 1 crore, additional 1 crore, because 1 crore is already recognized on 1st October 2020. ABC get further additional information from the customer, and with that information ABC Limited concluded that the fair value of the liability becomes 2 crore. So additional 1 crore is to be recognized due to the facts exist on the acquisition. Means if any new information is available after acquisition date for the event which is present at the time of acquisition, in that case it will be adjusted with the goodwill. Hence, these additional 1 crore on account of contingent liability shall be adjusted in business combination account. Now step 4. Impacts of information available after measurement period. That is measurement period is 15 January 2023 to 14th January 2020. So what was the impact available after measurement period? That is on February 2024. On February 2024, as per Ind AS 37, the contingent liability becomes 2.2 crores. After February 2024, that is after measurement period, customer has provided some additional information due to which the fair value of the contingent liability of the claim at the date of acquisition is 1.9. So any change in the value of contingent liability due to new information available after measurement period, it should be charged to profit and loss account and not with the goodwill, and not adjusted with the goodwill. So contingent liability as per Ind AS 37 is 2.2 crores, less already recognized in the books as per business combination accounting is 2 crore. 2 crore is already recognized. That differential amount is not adjusted in the business combination accounting. It should be charged to profit and loss account. So these 20 lakh, which is after measurement period, it should not be adjusted with the value of goodwill. It should be directly charged to. Now concept of pre-existing relationship, that is prior to acquisition of business. What was the concept of pre-existing relationship? If any transaction happens before the acquisition, if any transaction happens before the acquisition between the acquirer and the acquiree, that transaction is called a pre-existing transaction or prior to the acquisition of business. If any transaction happens between the acquirer or acquiree before acquisition of business and the transaction is settled at the time of acquisition of business. For example, if any suit filed by the acquiring company before acquisition on the acquirer company, if any suit filed by the customer vendor of the acquiring company before acquisition on the acquirer company, if any franchisee agreement is present before the acquisition and settlement happens or at the time of acquisition between the acquirer and acquiree, any sale of goods or supply of contract relationship is exist before the acquisition between the acquirer and acquiree. Any other contract between the acquirer and acquiree. So these are the examples. These are the pre-existing relationship between the acquirer and acquiree before acquisition, and that transaction is settled on the acquisition date. For accounting entry, pre-existing relationship shall not form part of the business combination accounting, that is goodwill accounting. Settlement of pre-existing relationship shall be accounted in the profit and loss account. So any pre-existing relationship shall not form part of the business combination accounting, that is goodwill accounting. It should be charged to profit and loss account. Now this concept of pre-existing relationship is explained with the help of example. Suppose X Limited is being sued by Y Limited for an infringement of its patent as on 31st March 2024. X Limited recognized a 30 million liability related to this litigation. On 30 July 2024, X Limited acquired the entire equity of Y Limited and paid a purchase consideration of 1500 millions. On that date, the estimated fair value of the expected settlement of the litigation is 60 million. In these, what is the purchase consideration after settling the liability or suit filed by? So the total purchase consideration paid by X Limited to Y Limited is 1500 millions, including pre-existing liability, because a suit has been filed by Y Limited to X Limited for an infringement of patent as on 31st March 2024. And X Limited recognized a 30 million liability related to this litigation before acquisition. Acquisition date is 30 July 2024. And the suit has been filed by Y Limited on X Limited is on 31st March 2024. So on the date of acquisition, X Limited paid a purchase consideration of 1500 millions. And on the acquisition date, he determined the pre-existing litigation which is existed between the X and Y Limited. The fair value of that litigation settled at 60 million, and the book value of that liability at the time of before the acquisition date, that is on 31st March 2024, when the suit has been filed and liability is recognized in the book of X Limited, is 30 million. So in this case, actual purchase consideration becomes not 1500 millions, it becomes 1500 million is total purchase consideration, which includes the pre-existing liability also. So in this case, actual purchase consideration which become the part of business combination is 1500 minus 60 million, because 60 million is paid for pre-existing liability which should be charged to profit and loss account and which should not be become a part of purchase consideration, or which is not be accounted as business combination accounting. 1500 million minus 60 million, it becomes 1440 millions. So discharge of all liability before acquisition of business, that is 60 million. How should compute goodwill in this case? That is purchase consideration is 1440 millions less net asset acquired at fair value, which is not given in the question, but the concept is there to understand that purchase consideration includes the pre-existing liability that should be separated from the value of the purchase consideration, and it should not be part of goodwill. It become that pre-existing liability, that is 60 millions, is to be charged to profit and loss account. So journal entries become before acquisition, X Limited will recognize in its books as profit and loss account, suit filed account debit to provision for liability, that is 30 million at book value. At the time of acquisition, that is on 30th July 2024, the fair value of that liability becomes 60 million. So 30 million is already recognized by X Limited in its books before acquisition, and he will further recognize that is 30 million, that is profit and loss account, suit file account debit to provision for liability, further 30 million, because further 30 million as fair value of liability on the date of acquisition is 60 million. Now at the time of payment, the provision for liability is to be debited by 60 millions to bank. Now illustration. Sun Limited acquired 100% in Moon Limited, which is owned by single shareholder R Limited, who is also the KMPs of Moon Limited. Sun Limited agrees to pay as purchase consideration for acquisition that is 20 million USD, and contingent payment is USD 2 million after 2 years. If the following condition met, margin of the company after post acquisition is 21. The former shareholder shall continue to be an employee with the Moon Limited for 2 years after the acquisition. No part of the contingent payment will be paid if the former shareholder does not continue to be an employee of the Moon Limited. Means what happened in this case? Sun Limited acquire 100% in Moon Limited, which is owned by the single shareholder R Limited, who is also the KMPs of the Moon Limited. So Sun Limited agrees to pay a purchase consideration for acquisition of Moon Limited 20 million USD and contingent payment of 2 million USD after 2 years. And payment is only made if the following condition met, that is, if the EBITDA margin of the company after post acquisition is 21% and the former shareholders have continued to be an employee of Moon Limited after acquisition for 2 years. No part of the contingent payment will be paid if the former shareholder does not continue to be an employee of Moon Limited. So, solution, the total amount paid by the company for acquisition is firstly the purchase consideration they are paying, that is 20 millions, and also the contingent consideration they are paying if they fulfill the following condition, that is if the company meet the EBITDA condition by reaching it at 25%, and if the former employee of the Moon Limited becomes the continue to be an employee of the company for 2 years after acquisition. So in this case, computation of goodwill on purchase consideration is 20 millions and contingent consideration is not taken into consideration while computing goodwill. These 2 million USD is not for continuation or acquisition of business. These 2 millions, this contingent consideration is not paid for acquisition of business, for continuation of business. Rather, this is paid for the KMPs to continue. Therefore, such contingent payment shall not be recognized. For calculating the goodwill, for computing the goodwill as a business combination, it should be recognized as employees benefit cost. So journal entry becomes employee benefit expense account debit, that is 2 million USD, to provision for liability 2 million USD, and subsequent accounting means these provision will be re-estimated on each reporting date as per Ind AS 37. Provision for employees benefit is to be re-estimated each reporting date as per Ind AS 37. Now, concept of ESOP, that is making payment to employees of the acquiring company in ESOP. Means what was the concept of ESOP? That is the acquirer company is making a payment in the form of ESOP to the acquiring company. Suppose A Limited acquire B Limited, and before acquisition B Limited gives to its employees some ESOPs. At the time of acquisition, when A Limited acquire B Limited, A Limited pay ESOP, that is its own company shares, to the employees of B Limited, and thus, and due to this transaction, whatever ESOP that is B Limited is issuing to its employees before acquisition get cancelled, because A Limited issued its own company shares to the employees of B Limited and it cancelled the shares which is already given by the employees of B Limited before acquisition by B Limited. So accounting treatment, pre-business combination, that is market value of B Limited. What is the market value of the ESOPs of B Limited by total period into vesting period? This will be considered as a part of business combination. Pre-business combination is considered as a part of business combination, and post-business combination will be adjusted in the profit and loss account. That is market value of new ESOP issued by A Limited minus pre-business combination. Any differential amount is value is there, should be adjusted in the profit and loss. Now illustration. This concept, ESOP concept, is explained with the help of example. Suppose Vedanta acquired Meenakshi Energy Limited and it's replaced the existing issue of Meenakshi Energy Limited, whose original vesting period is 5 years. Vedanta replaced the original award with its own share-based payment award. Under the replacement award, the vesting period is reduced to 2 years. How to compute the market value of award at the acquisition date in original award equals to 500, replacement award equals to 600. As the acquisition date, all the awards are expected to vest. Pre-acquisition value of the acquiry award divided by total period into vested period. Value of the acquiry award is the market value of the award at the acquisition date on original award equals to 500 and total vesting period is 5 years and vested period is 2 years. So it becomes pre-acquisition value is 200 and post-acquisition value, that is market value of the acquirers issue, that is replacement award, is 600 minus pre-business combination value, that is we are determining pre-acquisition value, that is 200. So post-acquisition value becomes 600 minus 200, it becomes 400. In this case, the vesting period is 2 years, which will be charged to profit and loss account over. Classic Limited acquired 60% stake in Natural Limited and paid a purchase consideration of rupees 97.5 crores. The fair value of net asset acquired is 150 crores. The fair value of non-controlling interest, that is 40%, is 65 crores and the book value of net asset acquired of Natural Limited is 120. How will the NCI be measured? There is a two method for computing the non-controlling interest, that is net. Firstly, the fair value approach, that is, and then another one is the proportionate basis approach. In fair value approach, the value is given in the question, that is the fair value of non-controlling interest 40% stake is 65 crores. So 65 crores is given, that is the fair value approach. And a proportionate basis approach means the fair value of net asset acquired, that is 150 crores into the percentage of non-controlling interest, that is 40%. So 150 into 40%, it becomes 60 crores. That is the proportionate basis approach. So step 1 is to compute non-controlling interest in both the approach. Fair value approach is 65 crores and proportionate basis approach is 60 crores. Now computation of goodwill or bargain purchase gain in scenario 1 and scenario 2. In scenario 1, where the non-controlling interest is recognized as fair value approach, the purchase consideration paid is 60%, that is 97.5 crores. Less net asset acquired 100% at fair value is 150 crores. Add non-controlling interest 40%, 65 crores. So purchase consideration 97.5 plus 65 crores, it becomes 162.5 crores, from which the net asset acquired at fair value 150 crores is reduced. So in this case, purchase consideration plus non-controlling interest is more than net asset acquired. So it is a case of goodwill, that is 12.5 crores. And in proportionate basis approach, the purchase consideration, the second scenario is proportionate basis approach, where the purchase consideration is 60%, that is 97.5 crores, less net asset acquired at fair value 100%, that is 150 crores, add non-controlling interest 40%, that is 60 crores on proportionate. 97.5 plus 60, it becomes 157.5 crores, less net asset acquired at fair value 150 crores, so it becomes 7.5 crores goodwill. Goodwill 7.5 crores in scenario 2 and in scenario 1 the goodwill becomes 12.5 crores. Now the journal entry, in scenario 1 net asset acquired account debit 150 crores, goodwill account debit 12.5 crores, to purchase consideration 97.5 crores, to non-controlling interest 65 crores. In scenario 2, net asset acquired 150 crores, goodwill account debit 7.5 crores, to purchase consideration 97.5 crores to non-controlling interest. Now the concept related to reverse acquisition. Reverse acquisition is another concept is suppose X Limited merge with Y Limited, that is the listed company. Now only Y Limited remain existed as X Limited fully merged with Y Limited. So in the above case, X is a private limited company and Y is a listed company, and X Limited get merged into Y Limited, and there is only Y Limited after acquisition. Y Limited is going to sustain and X Limited cease to exist. Now in this case what happened? X Limited is the legal acquirer because X Limited merged with Y Limited. It becomes a legal acquirer and accounting acquiree, and Y Limited becomes a legal acquiree. In legal form, Y Limited is a acquiree, but accounting acquirer. Accounting is done in the books of Y Limited as an acquirer because after merger, only Y Limited exists. So business combination is done in the books of Y Limited, not in the books of accounting treatment. Legal acquiree will be considered as an accounting acquirer. Who is the legal acquiree in this case? Y Limited. Y Limited is a legal acquiree, and Y Limited is considered as an accounting acquirer because business combination accounting is done in the books of Y Limited, and legal acquirer will be considered as an accounting acquirer. Business combination accounting is to be done in the books of accounting acquirer, that is Y Limited. Goodwill is to be recognized in the books of accounting acquirer, that is in the books of Y Limited, and rest all the concepts of business combination will remain. Now the concept related to step acquisition. The step acquisition process is to be explained with the help of example. Suppose on 1st January 2024, A Limited acquire 40% stake in B Limited. Further, on 30th June 2024, A Limited acquire additional 20% stake in B Limited, and the total acquisition of A Limited over B Limited is 60%, which is more than 50%, and thus A Limited acquire control over B Limited. So where one entity acquire control by acquiring step acquisition, step by step they acquire the stake in another entity, and at a point when they acquire control over the another entity, that is the concept of step acquisition. What was the treatment when A Limited does not have control over B Limited? That is on 1st January 2024, when A Limited acquired 40% stake in B Limited, but A Limited does not have a control over B Limited. Then at that time, what accounting treatment he will do? He will do the accounting treatment as equity accounting is done as per Ind AS 28. But when A Limited have a control over B Limited, when it acquires 60% stake over B Limited, that is on 30 June 2024, when A Limited further 20% stake in B Limited. Now the total acquisition of A Limited over B Limited is 60%, which is more than 50%, and now the A Limited acquire control over B Limited. In that time, business combination accounting is to be done on 30 June 2024, that is the date of control. No need to equity accounting now anymore after the date of control. Determine the fair value of investment before the date of control. 40% stake, which is before the acquisition of control. Computation of goodwill. How to compute goodwill and bargain purchase consideration less net asset acquired at fair value. Add non-controlling interest, because in this case 60% stake is acquired by A Limited, 40% is the non-controlling interest. Less fair value of past investments, then goodwill is or bargain purchases. Now the second method of business combination is common control transaction. Common control transaction is what? These transactions happen within a group. If any transaction happen within a group is the common control transaction. Before going to the definition of common control transaction is a carving in Ind AS 103, as this guidance is not available in IFRS 3. Because these common control transaction guidance is available in Ind AS 103, but this guidance is not available in IFRS 3. So it is carving. Ind AS 103 provides these additional guidance on common control transaction. What is common control transaction? Common control transaction is a business combination in which combining entities or businesses shall be under control. Shall be under the same control. Any transaction happen within a group is a common control. Thus, the common control transaction includes the transfer of business or entity between the group or subsidiaries or fellow subsidiaries. If any transaction happen between the group or subsidiaries or fellow subsidiaries, then that transaction is to be treated as a common now there are different situations of common control transaction, that is a transfer of business from one subsidiary to another subsidiary, transfer of subsidiary to another fellow subsidiary, merger of subsidiary into parent, merger of parent into subsidiary, transaction between the company whose directors are common. Now situation 1, let's explain the different situation of common control transaction with the help of example, that is transfer of business from one subsidiary to another. In this case, A Limited is there. A Limited is a holding company who has two subsidiaries, X Limited and Y Limited. X Limited has three businesses, that is X1, X2 and X3. X Limited transfer one of its business, that is X3 to the Y Limited. So Y Limited acquire one of the business of X Limited, that is X3 in business combination. So this is the case where the ultimate company is A Limited of the subsidiary, and this transaction takes place within a group companies, because there are two subsidiary, which is that subsidiary is a subsidiary of A Limited, which is the ultimate company. So this is a common control transaction where ultimate company, that is A Limited, holding 100% stake in X Limited and Y Limited, and if there is a transfer of X3 business of X Limited to another subsidiary Y Limited, then this is the common control transaction. Now another concept is transfer of subsidiary to another fellow subsidiary. If one subsidiary is transferred to another subsidiary, this is to be explained with the help of example. Suppose R Limited is the holding company where he has three subsidiaries, X Limited, Y Limited and Z Limited. Now after acquisition, what happens? X Limited acquires Z Limited. X Limited acquires Z Limited. So these transaction takes place within the fellow subsidiary, where the parent, ultimate parent is R Limited, who is the holding company who has three subsidiaries, X Limited, Y Limited and Z Limited, and X Limited acquires Z Limited, that is the fellow subsidiary. Revised structure is, now after acquisition, R Limited has only two subsidiaries left, that is X Limited and Y Limited, because Z Limited is acquired by X Limited. Z Limited becomes the subsidiary of X Limited and step down subsidiary of R Limited. This transaction is also a common control transaction because transaction takes place within the fellow subsidiary. Now merger of subsidiary into parent. This is also a case of common control transaction where ultimate company P Limited is the holding company who acquire 100% stake in S Limited, that is subsidiary company, which is get merged with parent company P Limited. So in this scenario, what happens? Where the S Limited get merged with P Limited, where the subsidiary company merge into a parent company, and the revised structure is after merger subsidiary company cease to exist. Since there is only an existence of parent company, that is two separate entity merged together and form a one entity. That is P Limited and S Limited merge together and form P Limited only, because S Limited merge into P Limited, and there is no existence after merger of S Limited, only P Limited sustained. So this transaction is also be a common control merger of parent into subsidiary. This is also a common control transaction where the ultimate company is U Limited. In this case, U Limited is the holding company and he has a subsidiary AM Limited. In this case, parent merge into subsidiary. Now, in this case, U Limited get merged with AM Limited. Now, there is no existence after merger of U Limited. Only AM Limited exists. So, This is also a common control transaction where ultimate company U Limited is the holding company merged with its subsidiary company, that is AM Limited, and after merger there is no existence of parent company as it is 100% merged with its subsidiary AM Limited. So revised structure is after merger parent company cease to exist and there is only an existence of subsidiary company, that is two separate entity merged together and form one entity. Now transaction between the company whose directors are common. Group of individuals who form ABCD Limited. That is A Limited is having 25% stake. ABCD Limited. B is having 25% stake. C is having 25% stake and D is also having a 25%. That group of individuals form an organization ABCD Limited. Another entity, that is XYZ Limited, is also formed by the same shareholders or directors, A, B and C. The directors or shareholders are common in both the organization who jointly control both the organization. So in the above case, if any business combination transaction happen between A, B, C, D Limited and XYZ Limited, where the directors are common or shareholders are common in both the entities and they operate jointly under a contractual arrangements, then that transaction are also be treated as a common control transaction. Where directors and shareholders are common in both the organization and they jointly operate as under a contractual agreement or arrangements, then that transaction is also called as a common control transaction. Now, accounting of common control transaction. How accounting is done in case of common control transaction? Common control transaction needs to be accounted as pooling of interest method. The method which is applied in the common control transaction is the pooling of interest method. Purchase consideration needs to be recognized at fair value. Assets or acquired or liability assumed to be recognized at book value and not at fair value. In common control transaction, all the purchase consideration is to be recognized at fair value, but assets liabilities to be recognized at book value and not at fair value. No hidden and intangibles is to be recognized. Identity of any reserve acquired shall be maintained if any reserve is acquired in common control transaction from the acquiring company, then that reserve is to be maintained. For example, debenture redemption reserve, security premium, etc. Previous year needs to be restated as if business combination has occurred on the opening of the comparative period. Means previous year needs to be restated in case of business combination in common control transaction as if business combination has occurred on the opening of the comparative period. However, where the control is acquired after the opening of the comparative period, business combination accounting to be done from the date means the date on which control has been acquired. Means if the business combination has occurred before the opening of the comparative period, then previous year needs to be restated along with the opening of the comparative period. Business combination is done after the opening of the comparative period, then business combination accounting is done from the date on which control has been acquired. No goodwill is recognized, that is difference between purchase consideration and net assets shall be recognized at capital. In case of common control transaction, goodwill is not recognized. If any difference arises between the purchase consideration and net asset acquired, that difference shall be treated as capital reserve and recognized as capital reserve in equity. Suppose in situation 1, purchase consideration is 200 crores and net asset acquired is 150 crores. And so 200 minus 150, that is positive 50 crore. In normal sense, we call it as a goodwill. But in case of common control transaction, goodwill is not recognized. It is a capital reserve, and in whether it's positive or negative, it should be adjusted with the capital reserve in it. And in situation 2, purchase consideration is 200 crores and net asset acquired is 250 crores. In this, the negative 50 crores. Note, in common control transaction, we do not recognize goodwill whether the transaction. Now we are going to discuss some of the examples related to common control transaction. Illustration 1, that is X Limited is the ultimate parent of large number of subsidiaries, reorganize its retail segment of its business to consolidate all of its retail business. Under reorganization, Company Z are the subsidiary and biggest retail company in the group acquire X Limited shareholding from one of its subsidiaries Y Limited by issuing the shares to the company of its company Z Limited. After that, Z Limited will directly control the operating and financial policies of Y Limited. So whether this transaction is a common control transaction or not. So before reorganizing, X Limited is the ultimate parent. He has a large number of subsidiaries, and also he has one of the subsidiary, that is Z Limited is also a subsidiary which is the biggest retail company in the group, and he is also a subsidiary called Y Limited. So X Limited has three subsidiaries: Y Limited, Z Limited, and large number of other subsidiaries before reorganizing. After reorganizing, what happened? Z Limited acquires Y Limited from X Limited by issuing its shares and operating directly the financial policies of the company Y Limited. So after reorganizing, the structure will be X Limited has two subsidiaries now, Z Limited and large number of other subsidiaries after reorganizing. And Z Limited directly operate Y Limited because he acquire all the shares of Y Limited and directly controlling and financial policies of Y. So solution in the example, the ultimate parent is same, that is X Limited before reorganization and after reorganization. Both Y Limited and Z Limited are ultimately controlled by X Limited before reorganization and after reorganization. So this is a transaction where one fellow subsidiary acquire 100% stake in another fellow subsidiary from ultimate parent, where the parent is same. So thus the above transaction is treated as a common control transaction. Now illustration 2, ABC Limited and XYZ Limited are owned by four shareholders, that is B, C, D and E, each of which are holding 25% stake. Shareholder B, C, D have entered into a shareholders arrangement in terms of governance of ABC Limited and governance of XYZ Limited, due to which they exercise joint control. Whether ABC Limited and XYZ Limited are under common control. Solution: as per the common control transaction, if any business combination transaction happens between the shareholders of ABC Limited and XYZ Limited, between the shareholders of two entities, where the shareholders are common in both the entity and they operate jointly under a contractual arrangements, then that transaction are also be treated as a common control transaction. Means if any business combination transaction happen between the shareholders of two entities, that is ABC Limited and XYZ Limited, and where the shareholders are common in both the organization and they operate jointly under an contractual arrangement, then that transaction are called as a treated as a common control. In the above example, there is a shareholders arrangement between the shareholders of ABC Limited and XYZ Limited, where shareholder BCD are common in both the organization and they operate jointly under a contractual agreement. Hence, the above transaction is treated as a common control transaction. Now, illustration 3. ABC Limited and XYZ Limited are owned by four shareholders, that is B, C, D, E, each of which are holding 25% stake. Now shareholder B, C and D does not have any entered into a shareholders agreement in terms of governance of ABC Limited and governance of XYZ Limited. Whether these transactions, whether ABC Limited and XYZ Limited are under common control solution. As per the common control transaction, if any business combination transaction happens between the shareholders of ABC Limited and XYZ Limited, where the shareholders are common in both the organization, both the entity, they jointly operate under a contractual arrangement, then that transaction are also treated as a common control transaction. But in the above situation, what happened? There is no shareholders agreement between the shareholders of ABC Limited and XYZ. Those shareholder B, C, D are common in both the organization, but they do not operate jointly under a contractual agreement. Hence, the above transaction is not treated as a common control. Illustration 4. ABC Limited acquire 100% holding on X Limited. Acquire 100% holding on X Limited, which is the subsidiary of LMO Limited on 1st April 2021. ABC Limited acquire another entity Y Limited on 1st April 2024. ABC Limited transfer all the shares of Y Limited to X Limited on 2nd April 2020. Whether ABC Limited and X Limited are under common control. Firstly, we will evaluate the transaction. ABC Limited acquire 100% stake of X Limited from LMO Limited, which is not a group company. X Limited is the subsidiary of LML Limited from which the ABC acquire X Limited, which is not a group company. Now, ABC Limited acquire X Limited on 1st April 2021. ABC Limited acquire another entity Y Limited on 1st April 2024. After acquiring Y Limited, ABC Limited, what he did, he transferred all the shares of Y Limited to X Limited on 2nd April 2024. That is next day of acquisition. He acquired Y Limited on 1st April 2024 and transfer all the shares of Y Limited to X Limited on 2nd April 2024. That is next day, on the next day of acquisition. Substance of the transaction needs to be checked. In that case, if we check the substance of the transaction, then the ultimate acquisition is done by X Limited and not by ABC Limited. Because on the next day of the acquisition, the ABC Limited transfer all the shares of Y Limited to the X Limited. So, purpose of the ABC Limited to acquire Y Limited is to transfer the business to X Limited. So, ultimate acquisition is done by X Limited and not by ABC Limited from LMA Limited, which is not a group company. It's a third party acquisition from third party. So, in the books of X Limited, who is the ultimate acquirer account, he applied acquisition method in its books and not a common control transaction. So, above transaction is not common control transaction, and common control method is not applied in this case. In this case, acquisition method needs to be applied. Substance of the transaction needs to be checked because though the purpose of the ABC Limited to acquire Y Limited and show in its books as a common control transaction, but substance of the transaction needs to be checked because on the next day of the acquisition, he transferred all the shares of Y Limited. Now, illustration 5. Common control period extends beyond the start of comparative period. XYZ Limited acquired PQR Limited in a common control transaction on 1st October 2023. The year end is 31st March 2024. XYZ Limited and PQR Limited having control by shareholders since their inception. Determine the comparative period and opening of the comparative period. Prior structure inception, shareholders acquire 100% in PQR Limited and XYZ Limited. As this mentioned that XYZ Limited and PQR Limited having controlled by shareholders since their inception. Since inception, it is controlled by shareholders. Shareholder acquire 100% in XYZ Limited and PQR Limited. That is the prior structure. The revised structure means XYZ Limited acquire PQR Limited in the common control transaction on 1st October 2023. Now the revised structure becomes shareholders acquired 100% in XYZ Limited and XYZ Limited acquire 100% in PQ. We have to determine the comparative period and opening of the comparative period. In our standard, what it says that the numbers are restated from the previous year of the comparative period of business combination as if business combination has occurred on the opening of the comparative period as per the accounting standard. Now in this case, the date of acquisition, XYZ Limited acquire PQR Limited on 1st October 2023. That is the date of acquisition. The year ended, financial year ends on 31st March 2024. That is the financial statement is prepared on that date. Comparative period of that financial year is 31st March 2023 and opening of the comparative period is 1st April 2020. And if the numbers are restated from the previous year of the comparative period, so it should be comparative periods are restated and opening of the comparative period are also restated. If the business combination has occurred after the opening of the comparative period, that is date of acquisition is 1st October 2023. That is after the opening of the comparative period is 1st April 2022. So the business combination is accounted for from the date of the opening of the comparative period and not from the date of acquisition in case of common control transaction. So in case of common control transaction, date of acquisition is 1st October 2023 and business combination accounting is not done from the date of acquisition, that is from 1st October 2020. It should be done from the opening of the comparative period, that is from 1st April 2020. All the business combination accounting is to be done in 1st April 2022. Capital reserve is determined on 1st April 2022. Assets and liabilities at book value from 1st April 2022. Opening of the comparative period is 1st April 2020. From that date, business combination accounting needs to be done and not from the date of acquisition, that is from 1st October. Now illustration 6. On 1st April 2019, A Limited acquire B Limited and C Limited. On 30th June 2024, B Limited acquired C Limited from A Limited. Now whether this transaction is a common control transaction and on which date business combination accounting is done or account is restated as per business combination. Now firstly we will evaluate the transaction. A Limited acquire B Limited on 1st April 2009. B Limited acquire C Limited from A Limited on 30 June 2024. Now the revised structure is B Limited is the subsidiary of A Limited and C Limited is the subsidiary of B Limited. The A Limited is the holding company under which the B Limited, and under B Limited there is a C Limited. So C Limited is the subsidiary of B Limited and B Limited is the subsidiary of A Limited. Thus, this transaction is a common control transaction as this transaction happen between the group companies and ultimate acquirer is same. Ultimate acquirer where A Limited is the ultimate acquirer and this transaction is happen between the group companies where one of the subsidiary acquire another subsidiary, fellow subsidiary from the ultimate. Then we will determine in case of common control transaction as per the standard. In case of common control transaction, the numbers are restated from the previous year of the comparative years of the business combination as if business combination has occurred on the opening of the comparative period. So in this case, the date of acquisition 30 June 2024. That is the date of acquisition. Financial statement prepared for the year ended 31st March 2025, and the comparative period of that year is 31st March 2024, which should be restated because comparative periods are restated and opening of the comparative period is also restated. So opening of the comparative period is 1st April 2023. So thus in these case, that is in case of common control transaction, business combination accounting is done from the date of opening of the comparative period. That is, opening of the comparative period is 1st April 2023 and not on the date of actual acquisition, that is 30th June 2024. That is the actual acquisition date. The net asset to be considered as of 1st April 2023, that is opening of the comparative period for computation of capital. So, illustration 7, on 1st December 2020, A Limited acquired B Limited and C Limited. On 30 June 2021, B Limited acquired C Limited from A Limited. Whether this transaction is a common control transaction and on which date business combination accounting is done or account is restated as per business combination. Solution: evaluation of transaction. A Limited acquire B Limited and C Limited on 1st December 2020. B Limited acquires C Limited from A Limited on 30 June 2021. So now the revised structure is B Limited is the subsidiary of A Limited and C Limited is the subsidiary of B. Thus this transaction is a common control transaction as this transaction happens between the group company and ultimate parent is same. Ultimate acquirer is same. So in this case, B Limited is the subsidiary of A Limited, where A Limited is the holding company and C Limited is the step down subsidiary of A Limited. Now, as per the standard, in case of common control transaction, where the control is acquired after the opening of the comparative period, business combination accounting to be done from the date means the date on which control has been acquired. So in this case, the date of acquisition is 30 June 2021. Financial statement prepared for the 31st March 2022. Comparative period is 31st March 2021, which should be restated, and opening of the comparative period is 1st April 2020. Control is acquired after the opening of the comparative period, that is on 1st December 2020, and opening of the comparative period is 1st April 2020. If control has been acquired after the opening of the comparative period, then the business combination accounting is to be done from the date when the control has been acquired and not from the opening of the comparative period. Thus, in these cases, in case of common control transaction, business combination accounting is done from the date when control is acquired after the opening of the comparative period. That is in this case from 1st December 2020 and not from 1st April 2020. So net asset to be considered for computing the capital reserve is from the date, that is from the date of control, that is on December 2020. Thanking you for watching my video. If you like, please share, subscribe my channel. Thank you.